Canada's big six banks just released their 2025 Q1 earnings. Who are the winners? Who are the losers? And who's ready for those US tariffs? Hold on to your seatbelts, folks. This is going to be a good one. The big six banks remain the backbone of our financial system, commanding enormous market caps and serving millions of Canadians. In fact, their reach extends well beyond our borders, and it's becoming clear that their international exposure is as much a risk as also an opportunity. The banks have two big stressors to contend with in the coming quarters. They still have the pandemic-era mortgage renewal wave, which is, it's now well underway, with the bulk of those renewals set to hit this year. Add to that the incoming U.S. tariffs, set to take effect on March 4th, imposing a sweeping 25% tariff across the board, save the energy sector, which gets a 10% tariff. So far in 2024, and into the beginning of this year, the banks have fared well with the mortgage renewals, thanks to their aggressive strategy of setting aside a lot of cash for their loan losses. For many renewals, rate shock was certainly present, but manageable for many mortgage holders. The real stress test for the banks comes this year, no doubt, as the low pandemic rates of sub 2% and sub 3% come up for renewal. These homeowners are now facing renewals at rates triple or even quadruple what they locked in during the pandemic, putting significant pressure on household finances and, of course, raising the risk of increased arrears. Overall, interest rates have come down, which is going to help, but there's still going to be significant losses. The rates that we have today are still significantly way above those rates they locked in during the pandemic. The banks are ready for these losses with their very large loan loss provisions, options for blended mortgage rates, as well as term extensions and tightening of their underwriting standards. So far, these measures have kept arrears and defaults contained, but the most challenging phase of that renewal wave, like I said, it is just beginning, and now the banks must manage this under the shadow of a growing external threat. The U.S. tariffs could not have picked a worse time to begin, with global growth already slowing and Canada's economy heavily reliant on U.S. trade. These measures will squeeze export revenues, pressure corporate profits, and, they're definitely going to trigger some job losses, especially in those manufacturing-heavy sectors. This will impact the banks in three ways. First, slower economic growth means higher unemployment, which can further strain borrowers already grappling with soaring mortgage payments. Next, businesses facing higher costs and reduced U.S. demand may see credit quality deteriorate, increasing the risk on defaults on business loans. Finally, investor confidence could take a hit, weighing on capital markets activity and investment banking revenue streams. While the banks have fortified their balance sheets, the combination of the most stressful phase of the mortgage renewal wave and a sudden trade shock from U.S. tariffs presents a rare double challenge. On the upside, if the Bank of Canada continues with anticipated rate cuts, it could soften the blow of renewals by easing some of the payment shock. However, if inflation remains sticky or if the U.S. tariffs spark new supply chain pressures, rate cuts may be more limited than hoped. As we watch 2025 unfold, the question isn't whether Canadian banks are prepared. It's whether their preparations will be enough. A sub to the channel is the best way to be prepared for future content. In just a moment, we will look at the main highlights of those Q1 earnings. Overall, the banks had a pretty good quarter. In fact, they all exceeded expectations, which is a rarity, as usually at least one of them misses. So who came out on top? Did any of them raise their dividends this time around? We are about to find out. So without any further ado, let's do this. Let's begin with Scotia Bank. Earnings-wise, they were expected to come in at $1.65. They actually beat that. They came in at $1.76, so they get a pass on that. When it comes to their revenue, they were expected to come in at $8.87 billion. They blew past that. They came in at $9.37 billion. They absolutely do get an overall pass, as these numbers do look pretty darn good. As for their dividends, they're still sitting at $1.06 per share, so that's a yield of 5.904%. So no changes for Scotiabank, and we kind of knew that. Looking at their earnings growth, they are anticipated to grow by 11.16% per year, so that's not too shabby. Their current price right now sitting at $71.82. So using a discounted cash flow model, we get a fair value of $130.02. That does paint them as being undervalued by 44.8%. Looking at their 1-year forecast, they are expected to grow to $80.53. So that's an increase of 12.1%. Now, it was not all hugs and kittens for Scotia Bank. They did report 1.6 billion in loan losses, and this was larger than the 1.09 billion that analysts had been hoping for. Okay, next we are going to look at Royal Bank. When it comes to their earnings, they were expecting $3.25. They came in with $3.62. So they do get a pass there. In terms of revenue, they were expecting to come in at 15.61 billion. They actually pulled out 16.74 billion. So yes, they get an overall pass for sure. When it comes to their dividend, they have a yield of 3.462%. It's a quarterly dividend, of course, $1.48 per share. No change this time around for Royal Bank. Their earnings growth rate is currently sitting at 4.25% per year. Their current price, $170.98, using a discounted cash flow model. We do get a fair value of $256.26. That paints them as being undervalued by 33.3%. On their 1-year forecast, they are anticipated to grow to $186.87. That is a 9.3% growth. Royal Bank did increase their loan loss provisions this quarter as they experienced a 34% increase in overall loan losses in the quarter. We can see that wave starting to roll in for sure. Up next, we have TD Bank. On the earnings front, they were expected to come in at $1.96. They actually came in at $2.02. So that's not too shabby. That's a pass on that. For the revenue front, they were expected to come in at $13.22 billion. They came in at $13.52 billion. So once again, another pass, an overall pass for TD Bank. Looking at their dividends, they have a yield of 4.848%, quarterly dividend, $1.05 a share. That has not changed. Their earnings growth, that's coming in at 8.73%. Looking at their current price, that is $86.40. Using a discounted cash flow model, once again, we get a fair value of $146.46. That does paint them as being undervalued by 40.8%. On their 1-year forecast, that's coming in at $90.53. So that's an increase of 4.5%. With the money laundering now behind them and a new CEO, TD is looking to move forward and hopefully keep beating expectations. Up next, we have CIBC. On the earnings front, they were expected to come in at $1.97. They actually came in at $2.20 for a pass. On the revenue front, they were expected to come in at $6.87 billion. They beat that. They came in at $7.28 billion. So they're also getting an overall pass. Looking at their dividends, they have a yield of 4.426%, 97-cent per share quarterly dividend. No changes here either. Their earnings are anticipated to grow by 8.62% per year. Their current price, of course, $87.67. Using a discounted cash flow model, we get a fair value of $162.11. That does paint them as undervalued by 45.9%. The 1-year forecast, $98.14. That's an increase of 11.9%. CIBC keeps pushing ahead at full speed as they did report a 26% rise in their quarterly profit. That was way ahead of expectations for sure. They also experienced a decline in their loan losses, but nonetheless put more money aside for that next wave. Let's take a look at BMO. They were expected earnings-wise to come in at $2.41. They actually came in at $3.04 for a pass. On that revenue scale, they were expected to come in at $8.62 billion. They came in at $9.27 billion. So once again, another pass, pretty solid pass for BMO. On the dividend front, they have a yield of 4.275%, quarterly dividend, $1.59 a share. No changes this time around. On to their earnings, they are expected to grow by 7.45% per year. Now, their current price is sitting at $148.76. Using a discounted cash flow model, we do get a fair value of $212.92. That paints them as being undervalued by 30.1%. On that 1 year forecast, they are anticipated to grow to $153.33. So that is an increase of 4.4%. BMO has had trouble keeping their loan losses within expectations over the last year, but this time around, they did come in with just over $1 billion, which was lower than expectations and did play a huge part in their overall performance for sure. Finally, we have National Bank. They were expected to come in with earnings of $2.65 per share. They came in at $2.93 for a nice little pass there. On their revenue, they were expected to come in at $3.03 billion. They beat that, $3.23 billion. So once again, they get an overall pass. All six of our banks got overall passes this time around. Looking at their dividend, they have a yield of 3.787%. That's $1.14 per share on that quarterly dividend. No changes on their dividend. So you'll also notice no dividend increases for any of the banks this time around, but that was very much expected. Next quarter, we're probably going to see some dividend increases. When it comes to their earnings, those are expected to grow by 10.98% per year. Their current price is sitting at $120.41. Discounted cash flow model, fair value, $204.10. That does paint them as being undervalued by 41%. On that 1 year forecast, they are anticipated to grow to $135.43. That's an increase of 12.5%. National Bank completed their acquisition of Canadian Western Bank, which is going to be a very good thing for their Western Canadian presence and their overall growth. Okay, let's take a look at them all together. When we look at their returns for the last year, we have a cool graphic showing them all in comparison to their share values. However, I do like to add in the dividends, so let's look at those total returns. Coming in dead last is TD Bank at 13.19%. But you know what, guys? It's not in the negative, so they've made quite an improvement. At number 5, we have Bank of Nova Scotia, Scotia Bank, 14.19%. National Bank in at number 4 with 15.56%. Bank of Montreal, number 3, 25.15%. Number 2, Royal Bank, 34.15%. And number 1, we're used to this now, CIBC coming in with 38.82%. As a bonus, let's take a quick peek at a few of those smaller banks just to see where they come in with their 1 year total returns. So we have Laurentian Bank coming in with 4.45% and EQB looking good, 19.44%. Of course, since the deal closed for National Bank's purchase of CWB, they're no longer on the market. Thus, our list has gotten a little shorter. We will be back here after the next quarter and do it all over again. We're going to see how these tariffs, what they're going to add to the story, and it could be a very interesting one for sure. If you are interested in any of the bank stocks that we looked at today, don't forget to put in a whole heaping helping of due diligence before you place any of your hard-earned money on the table. Let's continue that learning journey. Check out this video on BlackBerry. Thank you for watching, and I will see you in the next video.